The PSEI hit a high of 6,930 before mark-on-close transaction pulled the markets back to 6,850. Meanwhile, the S&P 500 hit another all-time high. Is it going to go any higher, or have we reached the peak? Let's look at some clues on how the markets may perform this week. My name is Den Slim, and welcome to another episode of Monday Market Outlook. So the week started off with good news as inflation eased to 2.8% in January, which was well below the estimates of 3.1%. So this was the lowest reading since October of 2020. The sharp deceleration essentially came down to the 20.8% decline in vegetable prices, which more than offset the worsening price of rice. Minor declines in oil, corn, meat, and sugar, as well as the surprising decline in the transportation line item, brought headline inflation down to the lower end of the BSP's target range of 2.83.5%. But looking at the month-on-month numbers, we did have a spike for January, something we also have to track moving forward, because we have to consider the base effect of the current inflation read. Remember that headline inflation is measured on a year-on-year basis. So we are comparing prices today against 12 months before. So if you look at last year's prices, they were at peak highs. So our lookout would be how headline inflation will look like once we start comparing the numbers against June or July. So we'll see, right? Also, unemployment numbers surprised to the downside, coming in at 3.1% against 3.6% forecast. We are also hitting recent lows as it dropped to its lowest level since 2005. But as unemployment continues to drop, this actually presents a stronger case for the BSP to pause rates. Remember that interest rates are currently at 6.5% after a surprise hike by the BSP last November. But with inflation down to 2.8%, shouldn't we start cutting rates? For now, it's too early for the BSP to do so because, again, we have to consider the base effects of inflation, and we will need to see once we compare inflation numbers against a lower base. And also with the unexpected drop in unemployment rate, this means that people have jobs, people have money to spend. So this could cause inflation to go back up. So last week, Finance Secretary Ralph Recto did communicate that rates have peaked, that it was high enough, and they will monitor Fed movements moving forward. So looking at the probabilities, we are unlikely to see any rate cuts in March, but there's a 90+% chance in June, and even an almost sure chance in July of a rate cut by even as much as 50 basis points. So we will now see whether the BSP does mirror Fed moves in the future and what the inflation numbers would look like, once we start comparing them with the lower base. In the meantime, the markets liked what it heard as the index surged past our 6,800 resistance level, as well as 6,900 briefly last Thursday before it closed at 6,850. What a week it has been for the Philippine market so far this year. Have we topped out yet? So we've seen the markets track along our ideal scenario, a pullback here, and then a strong rally breaking through the trend line support up to 6,900. But I didn't expect it to happen this fast, which may explain the mark on close last Thursday, or maybe it was just due to the long holiday. But at this point, we did mention that a pullback down to this downtrend line would keep the markets healthy, as it may help scoop in buyers to retest the 6,900 level and hopefully manage to base itself here on that level. So it could be possible for us to consolidate along 6,850, 6,950, or maybe a pullback down to 6,800 and a consolidation along this area. So next week's interest rate decision could be a non-event, as the market has already priced in a rate pause and no cuts are anticipated until June or maybe July, right? So a quick scroll through our watch list, we can see the top performing stocks in the last 5 days. On top here is Monde and ICT. ICT going up 11.5%, Monde up 13.33%. So congratulations if you were able to snag some shares when we pointed out that, you know, Monde could be up for a rally. Banking stocks also doing well, BDO and Metrobank. Ayala stocks also doing well, AREIT, Ali, and AC. Zooming out to the monthly charts, shows these stocks on the top end could have run its course and may experience a pullback in the coming weeks. But the ones here at the bottom, Meralco, AC, and AP, could just be starting to make their move. Now let's go to the Meralco chart. We can see that Meralco has been tracking this uptrend line here for quite some time until it broke this trend line support and settled down at 355. So at this point, we can see a phase 1 line, a phase 2 for the first cycle, and a phase 1, phase 2 on the second cycle, which now establishes a trend going downwards. So the thing with Meralco here is that it will now have to overcome this downtrend line, overcome this resistance line, and overcome 377 for us to believe that this rally, this upward rally here, is still intact. Now for Monde, let's look at the Monde chart. It has managed to touch this downtrend line, which goes way back to 2021. So a breakout here means a potential gap fill to 1104, but expect Monde to probably hit 1040, retrace back to this downtrend line to defend this support, and this could be a good chance for you to buy in. Now for banks, we have BDO almost hitting our take profit zone. I will be watching BDO closely on how it reacts to 155. BPI pulling back to 113. If it rebounds here, take profit zone is at 120. Watch how it reacts to 113 in the coming days. Metrobank, I'll be watching how it reacts at 60 pesos, and the next resistance would be at 61.70 and 62.75. Is this their last hurrah? I don't know, but this rally here may be a second chance for us to rotate out of banks if we haven't done so. If we look at the outlook for next year in terms of the EPS growth, we can see banks, BPI, Metrobank, BDO lagging behind the property stocks. So a rotation out of banks into properties may be something that you could consider. Meanwhile, Kung Si Fa Chai, as we celebrate Chinese New Year, and it will not be complete without looking at the China markets. Could the worst be over for the Hang Seng Index as we see price action forming higher lows in the past weeks? The China Tech ETF also showing a possible breakup or a breakdown along this flag pattern. Unfortunately, the China is so hated right now that the Nvidia stock is worth even more than the entire Chinese stock market. So as China grapples with the aggressive decline in their securities market, they have finally replaced the head of its securities regulator as frustration over the Chinese market has intensified. Now, looking at historical trends, this move tends to bode well for Chinese stocks as we see previous replacements of the main regulator more often than not resulted into an uptrend in the Chinese markets. Overall, looking at the big picture for China, most of the price action that is happening right now is coming off the backs of government stimulus. But at the end of the day, China still has a demand problem. So unless that can be addressed next year, the China market could still continue to track downwards. So we'll see. But in contrast, the US market reached new highs this Friday after the CPI seasonal adjustment came in unchanged on a full year basis, right? The 3.3 annualized rate remained unchanged, which confirms the progress on inflation, especially in the second half of last year. This gave more support that the strong growth and the resilient jobs market are not causing an acceleration in inflationary pressures. The revised CPI data has been eagerly awaited by the financial markets and economists after Fed Chair Christopher Waller last month indicated that the adjusted CPI number is a vital data piece that policymakers are watching in order to gauge their progress in their fight for inflation. What happened to the S&P 500? The index reached new highs as it continues its win streak, touching the 50-30 soft resistance to settle at 50-25. So we've had a spectacular run so far since October, and there's still no indication of a reversal in the trend. If we zoom in to the 1-hour charts, right, we can see that this trend is very much intact. We are still in this upward trend channel, right? And unless this breaks, we will continue to move on the upside. A pullback here could happen because we are on the upper band of this price channel. But if it rebounds off of 4,900 or 4,950, then there's a high likelihood that this rally will continue all the way to 50-70, which is the next resistance area based on the Fibonacci extension. No? At this point, there's really no previous resistances that will hold the markets back. Has the market peaked? Could we go higher? Right? Let's look at some breadth charts. The market breadth is starting to look better. Right? So while a few stocks were keeping the S&P 500 up, we can see a big improvement over the number of stocks above their moving averages. This is the 20-day moving averages, 56%, 50-day moving average, 100-day moving averages, and the 200-day moving average, all indicators pointing to an improvement in the strength in the broader markets. Let's look at the industrials. So the industrials ETF, right, is currently also at new highs. No? The industrial sector here gives us an insight into the sector that produces goods. It is also the sector that ships and delivers goods. And the chart here shows a bullish outlook. What is also helping to drive here is that the Dow Jones Transportation Index is also close to 2-year highs. Be on the lookout if this will follow the broader industrial sector to new highs. Because if we look at the Dow Jones Industrial Index, it has also broken into new highs. Now, so the Dow Jones Industrial Index and the Transportation Index are a pair of indicators that kind of confirms each other, as we ideally should see both indicators confirm each other's movement. As industries produce goods, you also want to see the transportation index go up, as these are the companies that deliver those goods. So for now, we can clearly see that the bulls are in charge. The market believes that the economy will continue their upward trajectory, at least for the foreseeable future, right? But watch out for the third week options expirations, as we may expect some volatility in the markets this week. As we mentioned, we are in the upper band of this price channel. We could pull back to 4,850. And look at where the options market sees the S&P 500 by Friday. We have a call wall here at 490, a put wall at 480, maximum pain at 479. So the markets do tend to consolidate along this area here 68% of the time. So we could be in for a pullback here, and even as deep as 4,850. So the imminent pullback could actually be this deep. Now remember that the seasonality charts also indicate that the markets peak in the middle of Feb, and we could be in for a correction very soon. Especially that Feb is traditionally the third worst month for the S&P 500 in the last 30 years. Now, more inflation data will come out on Tuesday, BSP decision on Thursday, and the Producers Price Index on Friday will continue to confirm if inflation is indeed under control. But for now, let's enjoy the market rally. Please don't chase prices. Yes, we think that the market may have more upside, but this is not the time to buy stocks. This is a time to hold your stocks and look for trend reversals, and then we decide if we want to sell, right? So this is not the right time to make FOMO trades. Do not let fear of missing out dictate your investment or trading decisions, right? So that's it for this week. Please like this video if you found the information useful. Please subscribe to the channel for more updates. And again, good luck with your trades. Please manage your risk accordingly. And I'll see you again next week. Bye-bye.